Okay, let us now discuss compensation structures. So, the most common one is what we call an LP GP structure. LP stands for limited partner or limited partners, and the GP is the general partner. The general partner is the manager, the fund manager, right? So let's say here's the fund. The GP is going to manage this fund. So the GP is the manager and the LP is the LPs are the investors. Now, as I told you earlier, typically what we have is a 220 compensation structure where there is a management fees of 2%, right? That's your 2% management fees, and then there'll be an incentive fees of 20%. What does that mean? So let's say the investors invest 100 million. So the assets under management are 100 million, and 2% of that will straightforward go to the manager for managing it, right? Regardless of the profit. And then let's say there is a profit on this. This goes to, let's say, 118. So there's a 18 million profit. So 20% of that 18 million will also go to the manager as incentive fees. So this is how the LPGP structure works. You have a general partner that manages the fund. You have limited partners that provide the capital. The word limited is because their liability is limited to the extent of their investment, right? If something horribly goes wrong in one of the investments, the liability of the limited partners is limited to the amount of their investment. The worst that can happen to them is they'll lose all their money, right? But the general partner, of course, is having unlimited liability. All right, what is the legal document between these guys? It's called an LPA or a limited partnership agreement, which outlines all the rules and the roles and responsibilities of all parties involved. Sometimes what happens is that some limited partners want customized arrangements. So then what you can have is a side letter that you can sign with them, giving them different terms than what your other limited partners have. Right. LPGP is not the only structure we have. We can have other types of compensation structures, especially with respect to infrastructure. Now, remember, I told you that here the government gets involved, and it's required as well because these are huge investments. And they have to be in the public space, and you're talking about motorways, highways, bridges, and it could be that the corporation that is set up is a public-private partnership and not your normal LPGP structure, which is there in hedge funds and private equity. In real estate, you could go for a joint venture structure where multiple parties come together and do real estate development. If we're talking about real estate fund investing, which is mostly trying to earn rental, so you have real estate investment trusts. These are very interesting structures as well because they have tax benefits. And there are certain requirements for them, such as, for example, they have to pay out 90% of their income to their unit holders. Otherwise, they lose that tax benefit. But the important point is that this is also another type of compensation structure that you can have within the alternative investment space. Now, coming back to the LPGP structure, as I told you, usually what we have is a 220 where the management fees is 2. It can be 1 as well, but usually what we see is that it is 2, and the incentive fees is 20%. Now, before I move on to more detailed discussion about the incentive fees, let me just highlight a very important part of the management fees, and that is something called committed capital. Now, if you're dealing with a hedge fund, then they, of course, have assets under management, and they will be getting this management fees applied to the assets under management. Now, with private equity, it is a little bit different. So let's say this is the LP, this is the GP, and this is the fund. And the fund is going to make the investments. Now, when the fund is being formed, there will be a certain committed capital, right? And that committed capital could be, let's say, 100 million. This 100 million will be called down into the fund at a later point. It's not called down immediately. It's not drawn down immediately, because the GP first has to search for suitable investments, appropriate investments. And until the GP doesn't have those suitable, appropriate investments, they're not going to ask the LPs to put in the money, right? They can have the LPs keep the money and earn some yield on it, some interest on it. But the important point is, even if the capital has not been called down, even if the capital has not been drawn down, the GP will still get the management fees on the total committed capital, because from the first day the GP has started thinking. They have started looking for the investments. So they are working on the entire committed capital amount, and therefore they deserve to get a management fees on the entire committed capital amount, even if it hasn't been fully called down or drawn down yet. So that is an important point. Now, moving to the performance fees, here it's going to be applied to the profit amount only, right? Now, there could be certain complexities over here. First of all, performance fees can have different names. It can be called the incentive fees or the carried interest. So I don't want you to get confused if you see a different name. They are all the same thing. It is called a performance fee. It is also called an incentive fee, also called a carried interest. Now, the second thing I want to be very careful of in questions is that, is it calculated? Let's say the fund is going from 100 million to 110 million. There has been a 10% gain. Now, this 20%, is it going to be paid out for that entire 10 million profit? Or are we going to subtract the management fees first from the profit and then see? So let's say if there's a 2% management fees, so actually the gain is not 10, it is just 8, because 2 of that is going in management fees. So this should be applied to the 8 million instead of the 10. Now, both approaches are correct. In the question, they will tell you if the performance fees is calculated net of management fees or independent of management fees, right? So if it is net of management fees, you'll subtract the management fees first. And if it is independent of management fees, then you'll just take it on the entire amount without subtracting the management fees. So that is an important point that I wanted to emphasize on. The second thing I want to talk about is the hurdle rate. Now, let's say your investment starting is 100 million and it goes to 118 million, right? The question is, will you get a performance fees if a hurdle rate is 8%? What that means is that up until 108, you will get nothing, because that's the minimum you have to earn as the GP to be able to ask the LP to share some of the profit, because the LP needs that minimum rate of return. And that is why it's called a hurdle, because you have to cross that hurdle. Now the hurdle can be of two types, a soft hurdle or a hard hurdle. Now clearly, let's say if it is going from 100 to 118, the hurdle has been crossed, right? The 8% hurdle has been crossed. Now in the case of a hard hurdle, that 20% profit will only be applicable to this additional amount, right, from 108 to 18. So you will only get 20% of the 10 million extra, which is above the hurdle rate in the case of a hard hurdle. But if it was a soft hurdle, we will get 20% of the entire 18 million from here till here, right? The only requirement in soft hurdle is that the return is more than the hurdle rate. If the return is less than the hurdle rate, then you don't get anything in hard hurdle and you don't get anything in soft hurdle. In both the cases, of course, the return has to be more than the hurdle rate. But in the case of the hard hurdle, you only get that incentive fees on the extra amount, the amount over and above what was required by the hurdle. And in the case of soft, you will get the incentive fees on the total amount above the investment, right? As long as the hurdle rate has been crossed. Right. So that is your hard hurdle and soft hurdle. Now let us talk about some more clauses, provisions, contingencies that can be there in your agreement, starting with the catch-up clause. Then we will move on to the high water mark, then waterfall, and then clawback. So let us get started with the catch-up clause. Now see, if your fund is going from 100 to 118, all the way from 100 to 108, let's say if there is a 8% hurdle rate, the GP is not getting anything, right? And they're kind of sad because they want to get 20% of the profits, but they're not getting anything until the hurdle rate. So what happens is that beyond the hurdle rate, first the GP catches up. So when you go from 108 to 110, right, this additional 2, the GP will take that entire 2 million because the LP has gotten 8 million so far. This has gone to the limited partner. That 2 million will go to the general partner. So that now they're in that agreed ratio of 80-20 so far, right? From the 100 all the way to 110, the profit has so far been 10 million, of which if 2 million is received by the GP and 8 million has been received by the LP, well, they've caught up because up until 108, only the LP was receiving money. GP was not receiving anything because it was below the hurdle rate. So the GP catches up. And this is the catch-up clause, that the GP catches up, bringing the split to 80-20. And then beyond that, going beyond that, it is just split. Every dollar that comes in is split 80-20. Let me show you. So again, the same example, from 100 you're going to 118, but the first 8% is going to the GP, right? Sorry, to the LP. The GP is not getting anything because the hurdle rate hasn't been crossed. But when you get to 108 and then after that till 110, that additional 2 goes to the GP. They catch up. Now your 80-20 is maintained and everything after that goes to the GP and LP in the 80-20 structure. So what ends up happening is that the GP catches up and they end up getting 20% of that entire 18%, right? And the LP gets 80% of the entire 18%. So this is what it's supposed to be. Now, if you didn't have this, if you didn't have the catch-up clause, what would happen is that the LP would receive the first 8 and then after that the split would start, right? So which means it would become sort of a hard hurdle and the GP would only receive 20% of that 10%, right? They would receive 20% of that additional 10%. They wouldn't receive 20% of the initial 8%. They would only receive 20% of that remaining 10% which comes after the initial 8%. and that would be more like a hard hurdle. So catch up clause is there for a soft hurdle. It helps the GP catch up. Now, next thing is high watermark, and let me draw this out for you. So let's say the investment starts with 100 million, goes up to 118, and the LP pays the performance fees, the incentive fees for this profit, right? But then the investment falls. And then let's say it falls to 110 from 118. Now I know the management fees has to be adjusted and the performance fees has to be adjusted, but that's not what I want to emphasize on. What I want to emphasize on is the concept of a high watermark. So just bear with me and let's hold everything else constant. So let's say you went from 100 to 118, fees was paid, but then you came down. You came down to 110, and then you went up to 130. Now, is the LP going to pay the GP the incentive fees from 110 to 130? Well, the answer is no, because there is a high watermark. All this amount, first, it has to be recovered because the LP has already paid an incentive to the GP up until 118. So the only extra profit that now is being generated is between 118 and 130. So this is called your high water mark, that first you have to achieve the highest level that you had achieved before. And then you have to cross that, and then you can talk about getting any incentive fees. Now, of course, this is seen net of fees, right? So that 118 was the high water mark, but then you would have paid some fees, management fees, incentive fees. So after adjusting the fees, whatever was the amount, that is what becomes the high water mark, depending on how much the fees was in that particular year. Now, waterfall, we have two types of waterfall structures. There's American and European. And let me just move on to that slide and tell you the difference between these two. So what happens is, European is good for LP and American is good for GP. Why? See, American is deal by deal basis. This is deal by deal. Now, let's say this is the GP, this is the LP, this is the fund, and the fund has investment A and investment B. Now, let's say investment A is doing really well and investment B is not doing so well. Now, what happens in the American structure is that the GP can say, oh, look, we made such a nice return for your investment A, so we're going to take the performance fees from that. And they can, because it's a deal by deal, right? So A is independent and B is independent. But if it was European, the GP wouldn't be able to take the performance fees from investment A because it would be seen together, right? That, okay, A has done well, but B hasn't done so well. So overall, have we met the hurdle rate for the entire fund or not? So that's why European is better for the limited partners, because their entire fund has to cross the hurdle rate. With the American, it's good for GP because it's deal by deal basis. Now, clawback provision, coming back to our initial example of 100 going to 118, right? And then let's say it's falling to, what was it falling to? 110, was it? I don't remember. Let me just check. In our previous example, yeah, 110. So let's say it comes down to 110 and then it goes up to 130. So it could be that there is something called a clawback provision, which means the GP pays the LP pays to the GP performance fees for going from 100 to 118. But when you fall from 118 to 110, you have to pay some of that fees back, right? The LP can reclaim part of the GP's performance fees, which then also means that there is no watermark, because now if it goes from 110 to 130, then the GP will get performance fees on the entire 110 to 130, because they repaid part of the fees that was paid to them from when they went from 100 to 118, right? So when there's a clawback clause, obviously because of the clawback provision, the high water mark will not be there. But in absence of the clawback, then there should be a high water mark, because if the LP has paid fees up to 118, then they should now only pay for amount above 118, right? So hopefully that makes sense to you. So, my friends, that is the end of this learning module. Very, very interesting start to alternative investments. We talked about the different features, how they are different from traditional investments of long only bonds, stocks, and cash. We talked about private capital, both equity and debt. Within equity, we talked about LBOs and venture capital. In debt, we talked about mezzanine and normal direct lending, mezzanine, lending to startups, right? And distressed. We talked about real assets such as real estate, different types of real estate, infrastructure with public private partnerships. We talked about natural resources. We got a little bit into hedge funds and their return calculations. Of course, all of this is going to be expanded in upcoming learning modules. This is just the first one. So you're just getting a high level overview over here. And what else did we talk about? That features that distinguish alternative investments from traditional. So specialized knowledge is required. There is a diversification benefit, but that diversification benefit, please take this with a pinch of salt. It just disappears in the time of crisis. So what good is it, right? Especially in the case of hedge funds. However, private capital and rental income still can be beneficial in times of crisis. But this comes at a higher illiquidity, right? Long time horizon is required and large capital outlays are required. It's not for everyone. Alternative investments are for those type of investors which have long term time horizons and large amount of money, because you can't buy real estate or private companies with just a few $1,000s. Right. So now, what are the methods available to us to get this exposure? Well, you could go through a fund. If you have only a few $1,000s, through a fund you can get an exposure, a diversified exposure, but be ready to pay them their fees, right? If you want to save on fees, you can partially save the fees by co-investing, which means you're kind of just copying the fund, right? You're alongside them, investing alongside them, which means you just copy what they're doing, but you're doing the investments directly. Now here, they're still choosing the investments, so you might have a problem of something called adverse selection, because you don't know what is the basis of them choosing these investments. Which then brings us to direct investing, where you not only do the direct investment yourself, you're even choosing which ones to invest in. But obviously, this is for big investment companies who have not only large amount of investments, because naturally you cannot come in with small money into this space, because you're talking about buying private companies and you're talking about buying real estate, but you also need to have that level of sophistication for the analysis. And then finally, we talked about compensation structures, starting with the LP GP structure and how the management fees and your performance fees is calculated, also called incentive fees or carried interest, with lots of different clauses of clawback provision, high watermark, and so on.